So welcome, latching onto trends using Elliott wave lenses. I always like to start out with the 3 pillars of trading success. What are the 3 pillars of trading success? What does a trader need to have in his or her trading arsenal to be successful, to make successful and consistent profits? Well, we believe that a trader needs the analysis, the strategy, and the coaching and accountability. So without one of these 3 pillars, it's highly likely that the trader will not succeed at trading. Having one without all 3, think about this, is like going on a hiking trip up a mountain without climbing gear. So many traders think that the strategy is enough, but it really isn't. Really, we really need all 3. So let's just start with the analysis and just work our way through these. And then I'm going to show you some important tips on how to tell when the trend is ending, when the new trend is beginning, and hopefully you'll be able to take away some your primer and Elliott wave analysis and mixed with a little bit of technical analysis today. So this is one of the key pillars, analysis. And we use Elliott wave analysis, and we actually use 3 types of analysis now in our Elliott wave ultimate: Elliott wave, Fibonacci, and harmonics. These are 3 big sciences used to analyze the markets. And I'm a big believer in studying the market cycles and studying the market cycles on any time frame, whether that's a 5-minute chart or a weekly chart, in order to get the market context and to know whether we're in a trend or a sideways market, and to be ready to really ride that trend when it appears and not to look back, just to keep going with the trend. And then to know when the market is pausing, because when the market is pausing, a lot of traders get chopped up. We're going to have a look at that in just a moment. So in our system, we use Elliott wave and harmonics, and it's all based on Fibonacci, in order to have market context and increase the likelihood of successful outcomes. That's really key here. We try to limit our losers and come up with high probability trades. So that's the analysis. Then you also need the strategy. Now everybody in this room has a strategy, I guarantee you that. And you may be continuously looking for more and more strategies every single day. And I call that being in the technical trader's trap, just constantly thinking that your strategy isn't good enough. Well, I have news for you. It's probably not about the strategy. It's probably more about you than your strategy. But having said that, we do need a highly effective strategy which is easy to understand when making a trading decision. So after a good analysis, the strategy is used to identify the exact entry point, the stop loss level, and the profit target to know when to trade and when to stay out of the market. I heard Pat talking about the exact same thing. So removing the emotions is key. How do we remove our emotions? We remove our emotions when we define a trade plan. And what does a trade plan include? The trade plan includes where you're going to trigger your trade, what is your exact entry point, where you're going to set your stop loss level. And your stop loss is going to be, wherever you set your stop, that's going to determine what your position size is going to be based on the amount of capital that you have in your account. So that's really, really important to know where you're setting your stop loss so that you can calculate the correct position size so that you don't blow your account on a trade that goes far against you with a bigger position. Because guess what? If you have a bigger stop loss, your position size needs to get smaller. It's as simple as that. And there's nothing wrong with having a big stop loss as long as you reduce that position size. And it is just as important to know when to stay out of the market, because there are times when we are in choppy markets. It is said that we trade in choppy markets, sideways markets, 70% of the time. Now lately we have been in tremendous trending markets. So we're very fortunate for that because market volatility has increased tremendously and we have had beautiful market moves. So that's the strategy. And our system uses the Elliott wave analysis with the wavy tunnel. And the wavy tunnel is our strategy. It's just it's a bunch of moving averages, and it lets us know what the market cycles are. It lets us count the waves without really being a consummate Elliott wave counter. And the third pillar, coaching and accountability. So coaching is really important, and coaching can be in the form of having your own trading buddies, being part of a chat room, being in a community of like-minded traders. That's what coaching means. It doesn't have to be an expert. It just, you need somebody to evaluate your trades and give you feedback so that you can correct your mistakes and polish the entries and the exits. I sound like I'm wearing my coaching hat here today because I'm also a trader's coach. I've done a lot in my career. I've traded for over 30 years, but I've also coached a lot of different traders. So accountability is key here. Even if you grab one trading buddy to share your trades with and plan your goals with and receive feedback, that's really important, because it's too easy for us to just hide behind our losses. How many of you have been in chat rooms where you hear from certain traders and they're always talking about the trades that they won? Well, I guarantee that they've also taken losses, and they might not just be fessing up to the trades that they're losing. So it's really important to fess up and to do sort of a post-mortem, a market review on the losses as well as the profitable trades on a daily or a weekly basis. So who was Ralph Nelson Elliott? He studied various market indices over a 75-year period in the 1930s, and he discovered that the stock markets, which were thought to behave in a chaotic manner, in fact did not. They traded in repetitive cycles, which he discovered were the emotions of investors, or the predominant psychology of the masses at the time. So this is a key pillar of achieving consistency, to have a thorough knowledge of the market to determine possible scenarios. So it's these cycles, or these waves, that we want to learn about today. And the wave principle states that patterns are tied to collective human behavior related to Fibonacci numbers. What you see on the left is the 8-wave cycle. And we're not going to go into the numbers there. If you're a numbers person and you know the Fibonacci sequence, you will be able to recognize that the 8-wave cycle and then the subwaves are all related to the Fibonacci sequence, and the numbers are right here from the sequence. 1, 3, 5. These are all numbers from the Fibonacci sequence. 8, 13, 21. And it's just a question of adding up, counting the waves, counting the waveform. So this is really neat for me to see, because I'm a numbers person, and I need a justification for anything that I did in my trading career, and this is it. This is it for me. Now, one thing about Elliott wave analysis is that it is based on the science of chaos, which means that complex shapes look different or look the same at different orders. They look the same, actually, at different orders of magnitude. So when we talk about things in nature like clouds in the sky or branches of the tree, if you tear off a branch from the tree, it looks like the whole tree itself. So that's a self-similar pattern that repeats over and over again. And we call that fractal, the fractal nature of the clouds in the sky or the branches of a tree. Or a fractal image. This is a fractal image based on the Fibonacci formulas. And here's another fractal image where you can see the patterns repeating over and over again. And as you can imagine, this applies to the markets as well. Here are the markets. And if you can learn what these patterns are, and these are Elliott wave patterns, and if you can learn the patterns and internalize the patterns, then you can trade these patterns in a boring way day in and day out, well, guess what? There's your bread and butter. So the markets are fractal. Find the patterns, see the patterns, and pocket the profit. So internalize the trend setups, internalize the end of the trend setups, and you will begin to recognize those setups, internalize them, and take market analysis, which is really what you're here to do. So markets are fractal. That's the good news. You can learn patterns, you can memorize those patterns, internalize those patterns, and when you see the patterns, make sure you pull the trigger, because that's how your bread and butter is made. It's really that simple. So let's talk a little bit about the cycles, trending versus sideways markets. We want to learn how to identify trending versus sideways markets, and I'm going to show you some examples shortly so we can talk about it in really a simplified manner. And then I will show you a wave count or two, we'll see. So there are only 3 things that a market can do. It says currencies here, but whatever market you're trading, it's the same thing. Go up in an uptrend, go down in a downtrend, or go sideways, or meander along in a correction. Now, one thing you have to know is not all trends are created equal, and not all sideways markets are created equal. Sometimes we can trade sideways for a long time, and we call that, in Elliott wave terminology, a complex combination. So it's a sideways combination of corrections. So that means that you might have a zigzag pattern, which is the flag pattern. You might have that zigzag pattern followed by another zigzag. You might have that followed by a box rectangle called a flat in Elliott wave terminology. This is the behavior of the sideways price action in markets. This is a picture of, excuse me, let's say 3 different time frames. So the red line will be the bigger time frame, let's say the daily chart, and then we work downwards. When I look at markets, I always look at bigger time frame first. We call that doing a top-down approach. So even if you're a day trader, and let's say you're trading off of the 5-minute chart or the 15-minute chart, you're going to want to look at the daily chart. You're going to want to see what's going on. Are we in a trend or not? Because if we are in a major trend on the daily chart and you're trading the 5-minute, it's very easy to have tunnel vision unless you get that perspective on the bigger time frame. It's very easy, if we're in downtrend, for you to buy on a 5-minute chart because you see divergence or because the market is doing a small correction, when in fact that might not be the path of least resistance. Like what might be the path of, what probably is the path of least resistance is to follow with the trend, and the only way you're going to know that is to look at a bigger time frame. So this is what this means. Do a top-down approach. The red line might be a daily, the green might be a 4-hour chart, and the dotted might be an hourly chart. And you can see that the hourly chart is going to cycle up and down with the daily. That's what it does. It just cycles up and down. So here's the dotted, it cycles up and down. We are in an uptrend, right? But when the dotted line cycles down and then turns around, this is really the time to buy. So every time the market cycles down and turns around, that's the time to buy in an uptrend. Same thing in a downtrend. Every time the market cycles up, that's the time to sell. So you want to sell on strength in a downtrend. You want to buy on weakness in an uptrend. So think buying on weakness, think selling on strength. It's counterintuitive because as traders, what we really want to do is we want to just sell when everybody else is selling, when the volume is moving up, when there's a lot of momentum in the markets. And you can do that as a momentum trader, that's fine. But as a position trader, as a swing trader, you want to finesse your moves. You want to sell when there's a lot of resistance, okay? And this is nothing new. When I worked at the bank in New York, I can remember telling my traders, sell on strength, buy on weakness. The same thing, and nothing has changed. The only thing that has changed is that the markets are more mature than they were 30 years ago. So 30 years ago, we had market moves that make today's moves seem muted, very muted. But the fundamentals are the same, and the skill building exercises are the same, and the mind games that we play with ourselves are the same. So we want to think sell on strength or think buy on weakness. And sometimes in order for us to really get that, we need to just practice it on a demo account and just keep on just reinforcing the behavior, and to get our minds to think really what you're doing is you're buying when everybody else is selling. You're being a contrarian, but you're going with the trend. I want to just touch on this because this is really, really important, and then we'll go to some examples in the market. This is also a downtrend, an end of the trend move, and now we have a move up and a move down, and we're at the crossroads. We're at a juncture here. What is the market going to do? Do we know at this point what it's going to do? We absolutely do not know what it's going to do. We can speculate, we can do our analysis and make certain assumptions, but what we do know is once the market does start to trade up and it takes out this 0.2, we have started a trend in the opposite direction, because a trend is higher highs and higher lows. So as soon as price trades up through this 0.2, we've started a new trend. If we continue on down and follow this red arrow down and we make a new low below 0.1, well, it means the market is still trading down. But at this juncture right here, we don't know. I mean, we might suppose that the market is going to change trend here and move up, which means that if we do make that assumption, our stops have to be below 0.1. This is called a 1, 2, 3 reversal pattern right here. And this is what I use very often all the time to confirm a new trend. So if I think that the trend is changing direction, then I'm going to look at a 1, 2, 3 reversal pattern on a smaller time frame maybe to confirm that we're changing trend. Okay, so remember this pattern. And now let's look at some examples in the market. This is the Australian dollar, and this is an example of what things that we want to look for when the market is changing trend. And we want to look for divergence, we want to look for a trend line break, and we want to look for a 1, 2, 3 reversal. I mean, this is a little mini trading strategy on its own. No wave counts, so this is the strategy part without the wave counts. Here we have a little note, end of trend with divergence followed by trend line break. So we have two red lines connecting the top trend, the tops and the bottoms of the candles, and we have divergence here. What is divergence? Divergence means that price is making a new high and the oscillator isn't, so it's making a lower high. This is the MACD. So we do have divergence here as price is moving up. What does it mean? It means that the market is running out of steam. Now, you could also see this if you're in the futures markets. You know, you look at volume as well, and you would see you could see divergence in volume. You could see divergence in other oscillators that you use. So divergence is just telling us, okay, the market is running out of steam. That's not to say that the market can't go higher, because we've been in very strongly trending markets where we have seen double and triple divergence. And you can't just keep selling. You need other confirming things going on at the same time. So one of those other confirmations is a trend line break, when price breaks down through the trend line. And typically, when it does break down through a trend line, it comes back up and retests, and then comes down. In this case, it went up and tested the upper channel line, and then just traded down in a corrective fashion until it moved up again. And then the third is the 1, 2, 3 reversal. You're going to see the 1, 2, 3 reversal at all market peaks and at all market bottoms. So you want to look at these three things: divergence, trend line break, and 1, 2, 3 reversal. The other thing that you want to do is to capture the trend or the corrective sequence by drawing your channels, because channels very often capture trends, and this is an example of a corrective sequence that it's also capturing. Okay, so get into the habit of drawing your channels, your channel lines. Very, very important. This is the Canadian dollar, a daily, and we'll look at the Canadian dollar in more detail, but this is just another example of, well, here, let's read this. Trend reversals occur at market tops and bottoms after a sideways move. Do we know at this point that the market is going to trade higher or lower? We have our first clue, divergence. So right here, the market is trending nicely in a channel. And we can draw a minor channel inside. The red lines are the minor channel inside the blue lines. So at this point right here, where are we going to go? I mean, you're probably looking at this, and if you know the price action, if you see the prices over here, well, you probably know where it's going to go. But from this picture, what does it look like? It looks like it's going to move up, right? Fine, it does look like it's going to move up. But if we break down through this channel line, that's if you do go along here, you have to leave your stop below here, and you have to expect that we will have more of a correction moving down. So our first clue, we do have divergence here. So it does look like the market is running out of steam. Let's see what happens. So this is it. In fact, the market does trade lower, and at this point we have divergence, we have the trend line break, and we have the 1, 2, 3 reversal pattern. And then we draw our channel lines moving in the opposite direction. So it actually did move down, and this is a nice corrective move down, and then the market starts to move up again. And just by drawing simple channel lines and looking at divergence, trend line break, and 1, 2, 3 reversals, you can get a lot of steam out of that. Well, imagine if we added the wave counts to this. That would really add perspective. The Elliott wave counts provide a roadmap, provide a GPS, really, on where we're going in the market. And let's see if we can learn from that on a subsequent slide. This is your 8-wave structure. So I think we need to talk a little bit about the wave personalities, and then we're going to look at the wave counts. We start off a move at point 0, and we end a trend at point T. And in between we have waves 1, 2, 3, 4, and 5. Now sometimes a wave is extended, and that's fine. If it's extended, it just means that we're going to have more than 5 waves within the channel lines. But do we really need to be able to count the waves within? It would be nice. It would be nice to have an Elliott wave, an Elliottician by your side counting waves for you, or to be able to subscribe to a service like we have, and that would be great. But I can also tell you that if we have an extended wave, an extended trend move, they're going to fall between the 2 channel lines. Okay? Now, as it happens, I have always followed Elliott wave counts, and now we have Juan, who does the Elliott wave counts for FX Trader's Edge, and he counts 18 different markets, and he's just fantastic, very accurate in his analysis. So at the bottom, the market is less emotional, as the market is still bearish at this point. No change in trend is evident. We showed the picture earlier where at this juncture we don't know if we're going to go down and make a new low right here, or if we're going to move up and start a new trend. So the market is sort of ambivalent at this point. And wave 2s are typically steep moves off of wave 1. So the market will move up, and a wave 2 is usually steep because, again, the market thinks we're still in a downtrend, and they're looking to sell the wave 2 moves. And this is where, if you're thinking that we're bottoming out and you see a double bottom, this is a low risk trade, because you would leave your stop below the low and do your analysis and your stop is right below the low and you're buying close to the low. So your stop isn't going to be so big here. Not that it matters, but when the stop is smaller, you can take a bigger position size. That's just that's how it goes as you become more experienced and as you learn how to manage your risk and to manage your money. Wave 3s is the powerful uptrend. So what happens in a wave 3? The wave 3 moves are steep. This is where we have a very steep slope. You're going to notice the price action just moving higher with very small corrections on the way up, very small corrections on the way up. So it's very good for profit potential. Every time the market makes a small corrective setback, you want to be buying and think buy on weakness. So wave 3s are usually strong. Wave 4s, that's when the market takes profits initially. So early traders are taking profits and others are entering long, and you do have some whipsaw price action here. This is where you can have some sideways consolidation that lasts, quite a few weeks, can last a long time, and you're sitting there trying to buy for the next move up to the wave 5, and you're getting smashed in the wave 4 correction. So in wave 4s, you can trade sideways markets for sure. You want to use your support and resistance, your pivot points, especially if you're day trading, but not even so. You want to use your support and resistance. And I like using pivot points daily, weekly, and monthly to look to see where buyers and sellers might come in. You can also draw manual support and resistance lines, going back in history and looking to see where there were pockets of buyers and sellers coming in which stopped the market price action. So definitely during a wave 4, you want to be plotting that support and resistance to see, so that you can trade both sides of the market. You don't want to be buying up here. You don't want to be selling down here. You want to be fading the moves. So fading means when the market moves up, you want to sell. When the market moves down, you want to buy. Wave 5 is the last advance, the last struggle to create new high prices, and this is where we see momentum divergences like we showed you, and this is where you're going to draw your channels and you're going to look for your trend line break and your 1, 2, 3 reversal. And this is very, very exciting when you do see the end of a trend move, because if it really is the end of a trend, whether it's a trend to move lower or a trend to move higher, if you spot it and you can get in and then you're in sync with the move, it can be, you're getting in early, it can be a nice trading. Now naturally, not everybody's going to get in at the top of the market or at the bottom of the market. We can't be perfectionists in our trading. We have to just know whether we're in a trend move, trend cycle, or a sideways move. But it is nice. There's certain trade setups that we have with the wavy tunnel for the end of the trend trade setup. So now we're coming back to the dollar Canada. We're going to pick up where we left off. This is what I showed you last with the divergence, the trend line break, and the 1, 2, 3 reversal. So the other thing that we use in our trading, and that you might try the same, we look at harmonic patterns at the end of the trend. Now, Elliott wave analysis provides us a way to forecast the wave 3s, for example, the market moves. It gives us a way to project the wave 3 vis-a-vis the wave 1. And the most common projections for the wave 3 moves are 100% of wave 1 to 161.8% times wave 1. And if it's a very extended wave 3, the move will continue on up towards 261.8, 423.6. These are extended moves. Now, looking at this picture, this is not an extended wave 3. well, this leg of it is not an extended wave 3. But what we do is we look for harmonic patterns at the end of the trends, and that gives us precise measurements as to where the price will stop. And when we combine that with our Elliott wave forecast or Elliott wave projection, and they line up at the same in the same convergence zone, that gives us more confidence as traders to take the trade. And in this case, it also lines up on the channel line. So the more confirmations you have as a trader, the more consistent you will be, the more confidence you will have in pulling that trigger. So when we add wave counts for context, this is really what it's all about for me anyway. This is the Canadian dollar. This only goes to the beginning of the year or to the end of the year, but I have the next slide will show us more recent data. We have a trend move, and it's captured by these channel lines. And if we look at the magenta wave count, we're labeling this a magenta wave 1. And after a wave 1 comes a corrective sequence for a wave 2, if you remember the chart that I showed you. And even the corrective sequences are bound by channel lines. So even if you are not a wave counter and you don't really know how to label the corrections are always labeled with A's, B's, and C's, and W, X's, and Y's for the complex. You can still draw your channel lines around the price data. Okay? And this is a wave 2. And then the market reverses, and we have the start of the wave 3. Okay? And it is a little bit complicated, but once again, we are trading within the channel lines. So what can you do as a trader? I mean, let's say you have a wave count and you're following the wave count. Well, that's the best. You're going to be wanting to buy every time the market retraces to the channel line, the lower channel line. Now notice where you're buying. You're buying at this wave 2. You're buying at this wave 2. You're buying at this wave 4. You're buying at this wave 2. You're buying at this wave 2. Every time the market corrects, it's going to correct to this channel line, and you want to be buying in an uptrend. So now I put up all the price data. This is the recent price action. This is the dollar Canada. And notice what happens here. Let me just get the spotlight here. So here we're trading up nicely in a nice channel, and this is the same picture that I showed you on the previous slide. Here is the end of the wave 2, the magenta wave 2, and then every time we came down for the wave 2, the wave 2, the wave 4. This is the same picture we would buy. Now look at what happens. For the wave 3, the trend changes slope. The trend becomes much steeper. And that typically happens in wave 3 moves. It becomes very steep, okay? But you still, and the corrections are shallow. Notice over here, in this part of the trend move, we had lots of moves down. We had lots of opportunities to buy this dollar Canada. Up here, not so, right? Not so. Sort of just traded higher. So with the Elliott wave count and with the context, how do you know that it's going to go up to 130? The only way to know is to look at the monthly chart and to, maybe I don't think I have the monthly chart here, and to run your Fibonacci now to get that perspective. So the dollar Canada came down from 160 to below par. This is, I guess this is roughly a 50% correction of that entire move down. That's where we are right now. So this is where we are right now. What do you say about this? This looks to me like similar to the picture that we showed earlier. We are trading within this range. This is very range bound. It looks kind of sluggish actually, and I would, even though our wave count is saying that the dollar Canada is going to move higher, because this is a wave 3, this is a wave 4, a wave 1, wave 2. We're looking for a move higher. to break through, maybe to get to 135 or so, and that would be the end of this cycle, I would not rule out a move below this trend line either. So we're at a really, really important juncture here in the dollar Canada. If we take out these price lows, there's no doubt that we're going to go lower. Okay? And in the meantime, what you can do is you can use your pivot points, your daily, weekly, and your monthly pivot points, and you want, depending on whether you're a day trader or a swing trader or a position taker, and you want to trade this range. This is a nice range to trade until we break through, we break out of that range. That's what we have to do. So if your bias is to the upside, then you want to be buying close to this level. Your stop is below. And you can take your profits up here, because where are we going to go? There are sellers up here. We know that. There are sellers up here because we have a lot of resistance up here. And I don't have the Fibonacci levels up here. I don't have the pivot points on here, but I can tell you that we have two-way price action here. So I have about 3 minutes left. I want to offer you a free course. Okay, you can go to fxtradersedge.com/free, and here you can find Juan's latest analysis on many different markets. Okay, this is what you would just sign up here, and then you could get the Elliott wave analysis on many different markets. That's the first thing that you get. And then you also get, I did a number of workshops here, which you may be interested in. An introductory workshop talking about trading as a business, fundamentals versus technicals, the process to make progress as a trader, and then workshop number 2 is all about support and resistance. So here's where I talk about support and resistance techniques, pivot points, average true range, Fibonacci basics. Very, very good. And number 3 workshop, I talk about the fundamentals and candlestick analysis, and we look at a weekly event calendar, and we talk about trading the news and how you trade the news. These are really full of action, these webinars. And then workshop number 4 is our Elliott Wave course offerings. We have a course called the Elliott Wave Ultimate. It's 4 courses in one: Elliott Wave analysis, Fibonacci, the wavy tunnel, which is our strategy, and harmonics, which is the icing on the cake. So you get all this for free. Enjoy. And this is what you get to analyze once you get through the course, and you get to understand all this, and you get to understand the different trade plans. And this is a picture that you will understand if you do eventually sign up for our course. We have a program going right now, so if you are interested, you might, go to the free zone and listen to the webinars, and you can sign up. But this is what you will be able to understand, and we're very precise. We measure all of our moves, and we have simple trading plans using our wavy tunnel strategy. We have 6 trading plans, 2 for our end of trend, and then 4 for the trend moves. Very, very nice. And here's just a testimonial by Andre P., who is a great trader. As a harmonic trader on a daily basis, I get to witness firsthand how the rhythm of the market is in sync with the mysterious Fibonacci order. The way price adheres to the hidden order, governed by the Fibonacci numbers beneath the surface of seeming chaos, always leaves me in awe. The Elliott Wave Ultimate System is an evolutionary leap in our understanding of this Fibonacci order because it combines both Elliott Wave and harmonics and reveals the profound interconnection between these 2 methodologies. No other trading system has so clearly demonstrated that ultimately these 2 methodologies are one. And the convergence of harmonics, Elliott Wave, and Fibonacci reveals the missing link in our understanding of the Fibonacci order behind the market action. If you want to expand your understanding of the market and take an evolutionary leap in your trading, I highly recommend this course. So this is for traders no matter what you're trading. If you're a numbers person, for sure. If you're a visual person, for sure, come join us. But in the meantime, go to fxtradersedge.com/free and enjoy with your free stuff. And that's all I have to say today.